Okay, so there was some interruptions in between. We will continue. So we computed up to labor over variances. Now variable overhead variances. Okay, now the formula for variable overhead variances depends upon the mode of recovery or absorption, whether the variable overheads are absorbed on the basis of number of units or based on the number of hours consumed. Okay, mode of absorption. If you see the question here, what is given here, you can find out that the variable overheads are absorbed on the basis of labor hours consumed. Okay, so it is on the basis of labor hours consumed. So you can write variable overheads are absorbed on the basis of labor hours consumed. Okay, what is the formula? The formula will be, we have already written the formula, SR into SH, then SR into AH, then actual variable overhead. Okay, what is actual variable overhead? Actual variable overhead incurred is 44,400. It is rupees 44,400. Now what is standard rate? Standard rate is the variable overhead absorption rate. Variable overhead absorption rate, it is given to be rupees 3 per hour. Okay, so rupees 3 into what is SH? SH is the standard hours for actual output. Okay, so SH is equal to standard hours for actual output or actual production. We have already computed that. Where did you compute? This is the calculation, SH for actual production, that is equal to 16,000 hours is the standard hours for 2000 units into 1800 units. So that will give you 3000. Is it 3600? No, it is 14,000. Okay, 16,000 divided by 2000 will give you 8 into 1800 will be 14,400. Okay, so this will be 14,400. Okay, now actual hours. What is actual hours? Actual hours consumed is how much? Is 16,000 here, right? Okay, so actual hours consumed is 16,000 here. So what is the total? 14,400 into 3 will be rupees 43,200, and here it will be rupees 48,000. So this is variable overhead cost variance. Okay, this is variable overhead cost variance. What is variable overhead cost variance? 43,200 minus 44,400. How much you get that? You get it as 1,200 adverse. Now what is this? Is variable overhead efficiency variance. Okay, efficiency variance, that is equal to 43,200 minus 48,000, that will give you 4,800. That is nothing but 4,800. Okay, so 4,800. Is it favorable or adverse? It is adverse. Now here, this is what? Variable overhead expenditure variance. What is the amount? It will be 48,000 minus 44,400. So you get 3,600 favorable. Okay, that is with respect to variable overheads. So we have computed variable overheads variances. Now next is fixed overhead variances. Here also you just need to compute the base level variances, nothing more or nothing detail. Okay, so what would be the formula? Here also the formula will be, okay, here FOH is also absorbed on the basis of what? Labor hours itself. So you can write that FOH is absorbed on the basis of labor hours consumed. Okay, so what would be the formula? The formula will be SR into SH, then SR into BH, then actual FOH. So what is actual FOH? Is 48,000. Then what is budgeted hours? Budgeted hours was how much? 16,000 hours. And what was the budgeted rate? The standard rate. Standard rate is rupees 3 per hour. Now what is SR? SR is rupees 3. And SH we have already computed, that is 14,400. Okay, 14,400. So 14,400. So this will be 14,400 into 3 will be 43,200. 43,200. This will be rupees 48,000. Okay, so you have two variances here and here. The first is FOH efficiency. Okay, efficiency variance and FOH volume variance and expenditure variance. Okay, this is FOH volume variance and FOH expenditure variance. Expenditure variance is nil, okay, but volume variance is 43,200 minus 48,000, that will come to 4,800 advance. And total FOH cost variance is 4,800 adverse. Is it clear? So that is FOH volume variances. Now you have to compute what? Sales margin volume variance. Sales margin variances. Sales margin variances. Okay, how do you compute the sales margin? Sales margin, if you see the question, is there any difference in the do you have any information regarding what? Regarding the selling price per unit? No, there is no information regarding the selling price. So what we have to do? We have to assume that the selling price is same as per the budget as well as the as per actuals. Okay, so you can write in the, okay, is there any information? Yeah, the information is there is no difference in budgeted and actual selling price. So you can write, it is given that the actual selling price is equal to budgeted selling price. Thus there will not be any sales margin price variance. Okay, and there is no information regarding the selling prices given also. Now sales margin variance, so the entire sales variance will be purely on account of, hence entire margin variance will be purely on account of, will be purely on account of what? Volume variance. Sales margin volume variance. Is it clear? Okay, so what is the formula for sales margin volume variance? Volume variance is equal to standard margin minus budgeted margin. Okay, standard margin means standard margin from actual output. How do you get that? What is the we have the information regarding the standard profit. Okay, so each unit gives you 56 rupees as standard profit. So standard margin will be standard profit per unit into actual output minus standard profit per unit into budgeted profit. That is equal to, what is standard profit per unit? 56 into 1800 minus 56 into budgeted output. That is equal to how much? 56 into 1800 will be 1,08,800 minus 56 into 2000 will be 112,000. That is equal to 100,800 minus 112,000, 11,200. Adverse. Why adverse? There is fall in the sales volume. So whenever there is fall in sales volume, the profit will be affected accordingly, and that give you adverse variance. Okay, now for the purpose of traditional variances, everything is over. Okay, now what you can do with the given information, you have to compute a reconciliation. Okay, reconciliation of profits. Which method? Traditional method of variance computation. You have to start with what? Budgeted profit. Budgeted profit. What is the budgeted profit? Rupees 56 into 2000. And what was that? Rupees 112,000. So figures in rupees. So you don't require this. Okay, fine. Now what do you have to do? Add favorable variances. What all are the favorable variances you have? Is there any favorable variance? Negative, adverse, then adverse, then going up, adverse, favorable. This is favorable, then adverse, yes. So the only favorable variance is what? Variable overhead expenditure variance, 3600 F. Okay, so what I am doing is, favorable variances I will add, and unfavorable variances I will put it in negative. Okay, for easy understanding. So what I am doing is, I am taking one by one. First let me take sales margin volume variance. sales margin volume variance, it is 11,200 adverse, so negative. Okay, now going to material usage variance. What is the amount? It is 8,000 negative because adverse. Then labor efficiency variance. What is labor efficiency variance? 3,200 negative because adverse. Now variable overhead, you have two variances in that. Variable overhead efficiency variance 4,800 adverse. $4,800 adverse. Now variable overhead expenditure variance. How much? It is 3,600 favorable. So add 3,600 positive. Now fixed overhead volume variance 4,800. $4,800 adverse. Okay, now this should get the actual profit. So how do you get that? 112 minus 11,200 minus 8,000 minus 3,200 minus 4,800 plus 3,600 minus 4,800. You will get the actual profit to be 83,600. Okay, now what do you have to do? So that is the first part. What was the question? Reconcile the budgeted and actual profit with the help of variance according to each of the following method. Conventional method is over. Now relevant cost method. 2 relevant cost method. Okay, in relevant cost method there are few things which we need to keep in mind. One is, in relevant cost method we employ standard marginal costing. In this method we consider what? Standard marginal costing. Okay, and what is the peculiarity of standard marginal costing? You don't have what? Fixed overhead volume variance will not be there. Okay, in standard marginal costing there will not be any fixed overhead volume variances, as fixed overheads are not absorbed to the cost objects. We have already seen this principle, right? Okay, are not absorbed to the cost objects. That's done with that. Okay, so there won't be any FOH overhead FOH volume variance in standard marginal costing. So even in relevant costing method there is no this one. Now there is another continuation to this problem. Relevant costing cost method, assuming that materials are scarce and restricted to supply 20,000 kilos. Labor hours are limited and available hours are only 16,000 hours. Okay, now when you use relevant costing, you will use only those costs which are relevant for decision making. Okay, so you can write, in relevant cost method we use only those costs which are relevant for decision making. Is it clear? Yes. In addition to that, there is one particular or peculiar aspect which we need to keep in mind with respect to the relevant cost analysis is what? We need to consider opportunity cost. especially when there is limiting factor, there may be what? Opportunity cost. Okay, now you can write that in relevant cost method, opportunity cost or gain is considered as a relevant cost or gain. Okay, whenever there is limiting factor or scarce resource due to which the maximum production is not achieved, there will be opportunity cost. Okay, there is limited supply, limiting factor. Whenever there is a limiting factor, any use or consumption of such limiting factor will have what? Opportunity cost. Because if you are not using that limiting fact for this particular purpose, you have somewhere else it can be employed, or for producing something else you can produce it, you can employ it. So there is opportunity cost. Okay, now I am going to derive another principle from standard cost perspective. Okay, so you can write, in a scenario where there is limiting factor. Okay, whenever there is a limiting factor, okay, any excess consumption of such limiting factor, any excess consumption of such limiting factor over and above the standard will result in opportunity cost. Am I right? Say for example, direct labor hours is a limiting factor. Okay, and as per standard, what do you want? 1 unit of output require, say, 2 labor hours. That is the standard. Okay, now as per actual data, 1 unit of output consumed 2.20 hours labor hours. So what is happening here? On one side it is a limiting factor, which means you are not able to produce maximum demand because the labor hours available is limited. Okay, that is there. And as per, if whenever there is a limiting factor, we will try to use the limiting factor in the optimum manner. So if the standard says that for producing 1 unit of output, you should consume only, require only 2 labor hours, that is the standard. You should go by that standard itself. Now suppose for consuming 1 unit of output, when the standard is 2 labor hours, you have actually consumed 2.20 labor hours. So for each unit you have consumed 0.20 hours excess. So naturally what will happen? When you are consuming more, it is resulting into an adverse variance. Okay, so this will result in an adverse variance due to more consumption. Okay. On the other hand, or along with that, when there is excess consumption, there is some sales lost because you have consumed this labor for this limiting factor in excess. Okay, when you consume 20.20 hours per unit, and suppose you say you have produced 5000 units, 5000 into 0.2 will come to 1000 hours you have consumed in excess, and this labor hours is a scarce resource or limiting factor. So when you consume 1000 hours in excess, what is happening there? You are not able to produce, you are not able to use that 1000 hours for some productive production. Okay, and based on the standard, this 1000 hours will give you how many output? Divided by 2, 500 outputs you would have produced with this. Okay, now due to your excess consumption, you are not able to get that 500 output, due to which your sales have been reduced, because you cannot produce it, you cannot sell it, so there is loss of contribution. Is it clear? So wherever there is what limiting factor, and you are using relevant costing as the basis for standard costing, then whenever there is an adverse variance, mind you, there will be opportunity cost. Okay, so result in adverse variance due to overconsumption. So in such scenario, the contribution lost from sales foregone due to the excess consumption will be an opportunity cost. Okay, therefore such loss of contribution. Why there is loss of contribution? Where will it get reflected? Ideally, in the traditional variance analysis, it will get reflected in the sales variance, because this will result in a variance between your budgeted quantity and your actual quantity. Okay, you have made a budget, okay, and based on that budget you have planned for some budgeted profit and all. Okay, now here your labor hours, which is a limiting factor, you consumed more for producing the existing production. So naturally what will happen, though you had budgeted 5000 units, you will be able to produce only lower number of units. So budgeted was 5000, but you produced only 4000, you sold only 4000. Okay, so there is a difference between budgeted quantity of sales and actual sales quantity, and this difference and the corresponding loss of contribution will be accounted as what? Sales variance. Okay, so under traditional costing, this opportunity cost will be accounted under sales variance, which in relevant costing have to be accounted as which variance? Labor variance. Okay, so therefore such loss of contribution should be considered under labor efficiency variance. Okay, you can write as a continuation, in the traditional costing, traditional or conventional standard costing, this contribution foregone would have accounted as, or under, would have accounted, it's not accounted, would have included under, would have included under sales volume variance. Thus it should be reverse from sales volume variance and should be added to what? Added to labor efficiency variance. Okay, now the same treatment will come for same treatment will be applicable for material usage variance when material is a limiting factor. Is a limiting factor. Is it clear? Okay. Now this is one scenario where there is excess consumption of such limiting factor over and above the standard. Okay. Now there could be a reverse situation also. Okay. Now short consumption of limiting factor as compared to the standard. Okay, say in the previous case I was telling about you are consuming the limiting factor in excess of your standard. Okay, there could be a reverse also. As per standard you could have consumed 2 hours per unit, but in fact in actuals you consumed only 1.8. So there is 0.2 what? 0.2 has been 0.2 is lower, consumption is lower. So when the consumption of your scarce your scarce resource is lower, your consumption of limiting factor is lower, what will happen to your production? Your production will increase. The production will go, actual production will go beyond what? Your budgeted production. Okay, so when your actual production is higher than budgeted production, there will be excess contribution you are getting, and that contribution will be accounted as sales volume variance as a favorable variance in the traditional accounting or traditional standard costing. But whereas in this case, in relevant costing, standard costing, what you have to do, this will be this opportunity gain or excess contribution earned from additional sales due to short consumption of limiting factor will be accounted as a gain or favorable variance under that particular cost variance of that limiting factor. Okay, so short consumption limiting factor as compared to the standard, this will result in excess production of output as compared to budgeted production. Okay, this will lead to what? Excess contribution from additional production and sales. Okay, now in traditional standard costing, this excess contribution will be included under what? Sales contribution volume variance. Contribution or sales volume variance as a favorable variance. favorable variance. However, under relevant costing, okay, it will be reduced from sales volume variance and will be adjusted against the cost variance of the respective limiting factor. Is it clear? So this is how you do. Okay, now let's see what should be done in the present case. Okay, so relevant cost method. Okay, in relevant cost method, you are not concerned about profit, you are concerned about what? Only the contribution. So in the conventional method, you are computing sales margin volume variance. Here you have to compute sales contribution volume variance. Okay, so sales contribution volume variance. Here also you don't have sales contribution price variance because there is no difference between the budgeted selling price and actual selling price. So this is equal to standard contribution minus budgeted contribution. And what is standard contribution per unit? This is equal to actual output into standard contribution per unit minus budgeted output into standard contribution per unit. Standard contribution per unit is equal to, you can do this calculation here, you can see this calculation. Okay, this, what you have to do, standard profit is given, with that you have to add fixed overhead. Standard profit per unit plus FOH per unit, that will give you what? 56 plus 24, 56 plus 24, that is rupees 80 per unit. Okay, so that is actual output is 1800 into 80 minus budgeted is 2000 into 80, so that is equal to 16,000 adverse, because actual standard contribution is lower than the budgeted contribution. Okay, so this you have done. Now what else you have to do? You can do the reconciliation statement. Okay, so how do you do the reconciliation statement? Okay, you have three scenarios. One, there is scarce material, then you have scarce labor, then there is no scarce input. Okay, so these two cases, there is limiting factor, there is limiting factor, there is no limiting factor. Okay, you start with budgeted profit. Okay, budgeted, we have already computed that, it is 112,000. 112,000. Now what do you have to do? You have to adjust the favorable and unfavorable, favorable and adverse variances. Okay, so you can take one by one. Add or minus variances adjusted. What are things we have to take? First is sales volume variances. I told you, whenever there is a limiting factor, if there will be opportunity cost, and that opportunity cost has to be adjusted from that particular limiting factor or cost of factor, whether it is material, then material cost, or if it is labor, labor cost variance, and the corresponding effect has to be given to where? Sales volume variance. So whenever there is limiting factor, there will be adjustment to the sales volume variance, which you can do only after you compute that particular calculation. But if there is no limiting factor, there is no adjustment to sales volume variance. So here you can straight away take what? You have already computed sales contribution volume variance as 16,000. So you take it as 16,000 negative here. And these two, for the time being, you keep blank and we will come to that. Okay, then material usage variance. Okay, in the case of material usage variance, when there is a scarce material, there is some impact, but when the labor is scarce, there won't be an impact. So here you can take 8,000 adverse, and when there is no scarce input, there also no impact, so 8,000. So this has been kept pending. Now labor,